Let's start with the big question. How do the big multi-manager hedge funds, namely Citadel, Point72, Balyasny, and Millennium,
Mhm.
how do they hire the best talent possible? What does that process look like?
First word that comes to mind is rigorous. So obviously, the name alone carries a lot of weight, right? And the way the industry kind of fluctuates and ebbs and flows, sometimes the name carries more weight than at other times, right? I think right now, from our vantage point, sometimes these big names might be losing out to talent in AI or startups and what have you, right? But to answer your question more directly on how are they attracting talent, they offer the best of the best platforms in all of financial services. And they offer the platform of the smartest, right? And I think for us, from our perspective, that's one of the elements that makes them stand out the most still. At this day and age, um, the multi-strat hedge fund industry is largely populated by the capital allocated by those four names that you just mentioned, right? So they sell themselves because the pod approach traditionally works, right? There are huge opportunities to own and take risk and to be on a desk or a pod that owns and takes a lot of risk, whether you're supporting that desk and pod or you're owning it yourself as the decision maker or revenue generator. So I guess that's my long-winded way of saying the way that these organizations, the way that those four primarily sell themselves is their name, and they have the toughest vetting process in all of financial services, and they inherently attract the smartest and the most talented for that reason.
Absolutely. And I think I'm laughing right now in my head because whenever I watch Ken Griffin talk, right, and he's there and he's in front of a lot of students and he loves to do these. I remember a quick side story, but he gave a talk at LSE and it was in the UK and it was only for LSE students. I went to UCL and I actually snuck into the talk just so I could watch him in person because I was curious,
Yes.
right? And the thing that he stresses in every single talk is that at Citadel, they hire the highest caliber of people possible. And he says that very often he says, we're a research firm first. Trading is how we execute that. And talent is how we implement, or talent is how we come up with the exceptional research that we produce. And I think that at all the multi-manager shops, they run this, I want to call it sort of a talent strategy where they get the best and brightest, they bring them in and they have them contribute. And we're seeing recently plenty of articles on the talent war that's happening. Whenever I talk to people in the industry, they say it over and over and over again.
Yep.
And I guess I want to hear some background. How did that come about? And what incentives led to that war, that's the talent war that's happening today?
So, I think it's no secret, right, that those talent or that talent platform is based in, for lack of a better term, the top 10 mentality, right? These types of firms only are looking for talent from top 10 research universities, top 10 master's programs, top 10 PhD programs in the US and globally, right? So they're not exclusive in that way, but it's a general principle that they're looking for best and brightest on paper as far as the diploma is concerned, right? I think additionally, something that we've seen over the last few years as well, especially, was and I think if I remember correctly, I think I first heard this from a client, but I think the phrase was, hedge funds used to hire if you were on, for example, let's say if you were on the Google Maps team, or if you were on the highest performing rates trading desk at Goldman Sachs. Now, the bar has been raised so much that they want the individual who invented Google Maps, right? Or the person who is now spearheading the next generation of Google Maps, or they want the head of the rates trading desk, right? I think that's the difference. That's the direction where the paradigm has shifted on to your earlier point, right? That we're in a bit of a different generation, even though it's a couple years, that talent bar is so much higher and it's so much more competitive now because these funds are in such a privileged position to be able to work exclusively with, again, that best and brightest.
Yeah, it's crazy. And we were talking on the right before this call, before we started recording, and you mentioned how much Balyasny spends on recruiting. I think it was $280 million. Am I correct?
It is. I actually just read that recently.
How did that come about? Like, how did the budget for talent expand so dramatically? And how is it like 280 million on a single firm is ridiculous, right?
Sure. Yeah. I think if you use the recent information that a fund like Balyasny spending $280 million, right? But just without getting into the specifics of numbers, if you just use the fact that these funds are spending a lot on talent, what's the incentive, right? I think there are a couple ways that I would think about this question. And one is from a tech and tools perspective, and another is from a competitor perspective. And the third is just generally, as the way the way of the world, if you liken it to sports, right? I actually read an article about this earlier this year that portfolio managers are signing contracts like athletes, right? Speaking of Balyasny, right? I believe they just brought someone on for an $80 million contract, right? That's like a 4-year deal in the major leagues, But at the same time, $80 million contracts weren't happening 10 years ago, or an $80 million contract, depending on the skill in sports, might be small compared to what it is now, right? So there's just so much more money. These funds are so acutely focused on alpha generation, whether it's systematic approaches and advancing systematic approaches to, utilizing data science and AI, again, to find that the smallest arbitrage, right? Again, referencing the pod model, right? They're hedge funds. So the pod model creates a way for them to work off of each other and balance each other, but also generate profits in an additional way. So I think they're largely boosted by technology, which has just kind of shifted this approach where they're making so much more money hand over fist that they can afford these, this talent. A little bit of a sidebar to that point. The candidates at this point in the cycle have a little bit more power than they had previously, right? There's the industry used to be heavily based in loyalty or wanting to have your name at the same place for 10, 15, 20 plus years and just kind of owning your pod, owning your portfolio forever. And just a natural shift in the cycle has been the fact that actually the candidates or the traders themselves have realized from their drawdowns, right? If they're not making any money or if they've made a loss, in order for them to make any money in their current role, they have to recoup that loss and then turn a profit, right? Whereas all of a sudden in the last couple of years, what's become more mainstream is the loyalty is gone, right? I think the term mercenary, I might have read in an article, but the loyalty is kind of out the window, and the trader has more power because they can go to a new firm that's willing to pay them, again, that $50 million, $80 million package, and start from scratch, right? Start from zero rather than starting in the negative. So that has also driven up the general price, right? If you think about supply and demand, just an economics 101, the candidates having power has created a leverage for them that's given them a lot more opportunity to maximize their own value in this market.
I guess I want to go now deep, or what I want to explore now, what the hedge funds look for from you specifically. Because, you were telling me you place a lot of more junior tech quants, analysts within these pods. And you told me that they look for people who are exceptional. And I think that's kind of a given. But I want to, let's say, take the quant example, right? What specific skills or traits do they typically screen for? When they're looking for these high performance to build up pods and, get funneled into these pods.
Yeah. I think to refer to something that I mentioned a little earlier, risk taking and risk appetite and risk exposure is really important to a lot of, I guess we can, stay, if we think about the big four hedge funds that you've just mentioned, right? The traditional multi-strats. Risk exposure is really important because there will be, and hands-on risk exposure, right? These funds are looking for individuals. Let's say they're coming from a top bank, right? It's well known that J.P. Morgan or Goldman Sachs are feeders into Millennium and Citadel, and the other two as well, obviously. So, if we think about that, the funds aren't looking for somebody who is on a team that makes suggestions. They want the individuals. Again, this is kind of how they separate good from great or great from the best, right? They're looking for the individuals who have systematically calculated and have the communication skills and the confidence to walk straight up to the decision maker, right? That pod owner or the trader themselves, and say, this is the conclusion that I've come to. This is why, and this is the amount of risk I think you can take on this trade, right? Not just again, to reiterate, not just the person who's on the team that might, be at the table. They want the decision maker on risk assessment and risk evaluation, for example, right? And that applies to a couple of different skill sets, right? That applies to your risk professionals. It applies to your quant professionals, right? To keep this relevant to the host and what he's studying. Those who are comfortable owning and taking risk and communicating their own risk if they're not the actual risk taker themselves. That's a big one. And I think something else that, as I mentioned, is where do they also stand in the cycle of utilization of a tech and tools, right? Are they the ones who are using these cutting edge technologies, or are they the ones who are the decision makers with these cutting edge technologies, especially if they're coming from tech, right? We see a lot of talent out of Meta still, out of Microsoft still, which is interesting, right? Kind of non-traditional finance into finance, but it's okay because the technology still applies and the impact that they can make is significant, right? So those individuals who are at the forefront of the development of those programs, the development of those languages, and especially in an AI-based world, that's what these funds are looking for. Those people who set themselves apart in that way.
So you mentioned two things. You mentioned propensity to take risks, so actual decision makers, and then people who are at the forefront of deploying technology, right? So those two things.
Among
Working in,
among many others,
among many,
but for
of
now,
course, of course. And so when you're evaluating candidates, how do you, working in recruitment, screen for those? Like, how do you actually screen for those? I guess not being fully technical.
yeah, yeah, that's a great question, and happy to peel back the curtain a little bit here. I think for us, first and foremost, if you think about what our titles are, I'm referring to the consultants and I just buried the lead there. I just gave away the answer. If you refer to what the people that work at our company, our recruiters are called, they're called consultants, right? So what I mean by that is it is incumbent upon them to really fundamentally and intrinsically understand our clients. So how do we vet for that? Anybody can look good on paper. Anybody can AI produce a resume. Anybody can inflate their resume. Anybody can tell a story that maybe is a little bit fabricated, if you will, right? But for us, the best way we go about that is really, as I say, intrinsically understanding the client and understanding how certain pods or certain groups within these clients operate so that we can represent them to the best of our ability, right? Again, if we know that a certain, just to use this risk example again, right? If we know that a certain client is really adamant about somebody who can communicate and explain confidently them owning and taking the risk, right? We can vet for that. That's just one example. Tell us about a time when, right? It's not just what is your Sharpe ratio per se,
Yeah.
right? It's about, we know that this group specifically really likes X, Y, and Z. Tell us how you've applied that in your current role, right? So that way we're not just looking at a resume, we're representing the client's particular needs and that line of business's particular needs.
I want to hear more about the risk-taking side when you're interviewing someone, because let's say you want to place someone who worked at a pod I'll just use firms as an example. He worked at a pod at Citadel, and now he wants to move to another one of the big full-time managers. Who owns the track record? So if he says, right, I've taken on this risk, this time, this particular instance, and I made X amount of dollars for my pod, can he say that honestly? Because I think one of the things I don't understand that well is the transparency around who owns the track record.
Yeah. Well, I think that depends on exactly who we're referring to, right? If the candidate you're talking about here is the actual risk owner, right? And that's really what all these pods are about. Millennium takes pride in, it's publicly, right? Millennium takes pride in their risk owners. So, if that's who's coming to us, then I think we know, right? There's a credibility, there's a unspoken credibility in the market that's who the risk owner is. That's, if they tell us this is what their, what their Sharpe is and what their track record looks like, then that's what we're presenting to the client, right? If we're working with a candidate who's maybe supported that risk owner, either from an engineering and software development perspective or a quantitative analysis perspective, then that's where we're asking those types of vetting questions to understand the performance of the pod, the performance of the team they're on, and what exactly are they specifically owning and doing from a behavioral and day-to-day perspective that elaborates what's on their resume.
And so I guess now we've talked a little bit about the dynamics of actually hiring the talent, and what people are looking for. I guess now I want to hear a little bit more about the broader trends that you see taking place in the industry. Yeah, what do you see happening on the ground? What do you like? We've talked a little bit about the talent war. I think that's going to continue. But is there any trend that you think is coming up now that you think will persist?
Yep. So, as I mentioned at the top, right, I think one of the biggest trends is the fact that we've gone from, in the last few years, the raising of the talent bar, right? We've gone from them wanting excellent members of excellent teams to the best member on the best team, right? That's one general talent trend that we're currently in the middle of. I think another is geographic. And obviously, as you rightly mentioned, Ken Griffin, he tends to be a harbinger of all things buy side. The way Jamie Dimon is the way Jamie Dimon is the harbinger of all things banks and generally financial services. So, when Ken Griffin moved Citadel headquarters to Miami, he obviously wasn't the first person to put any hedge fund employee in the state of Florida, but it kind of opened the floodgates for a talent, not necessarily exodus, but a talent migration, let's call it, right? So, what we've seen is funds like Citadel are moving to Florida, and not just what was traditionally technology or engineering for, these multi-strats, right? I believe Millennium was as well in engineering in Florida, as well as some analysts or middle office professionals. But at this point, the risk owners, the risk takers themselves are migrating to Florida as well, right? And to be honest, I don't think it's just tax reasons. Although I think, when you're making 7, 8, 9 figures, not paying taxes on it is certainly helpful. But I'd say that's probably the other biggest trend that we're seeing in the hedge fund industry right now is the migration to Florida, and then internationally, there's a lot in Dubai as well. We've seen quite a bit of development in the same, multi-strat fundamental skill set, risk owners moving to Dubai as well. And oftentimes those are traders from banks, but as well as the hedge fund portfolio managers as well.
And so what do you think's driving that? Because I think I live in New York. We both live in New York right now. It just seems like it's still the spot. I can't see Dubai competing. Well, obviously you have the taxes, and maybe that's pretty sweet.
The financial capital of the world is not going to be Dubai or Miami anytime soon. That's what you're saying.
Exactly.
Right?
Yeah, exactly.
Yeah,
exactly.
Ethan, I don't disagree with you. I think what has happened, these types of things happen, right? If I liken this in some sense to 2016, 2017, there was a massive migration to the Dallas, Texas area. JP Morgan, again, Jamie Dimon decided that's where he wants to build JP Morgan's next new headquarters. And now Goldman Sachs and JP Morgan have more employees in Texas than they do in New York. It doesn't mean that's fact. It doesn't mean that they aren't the headquarters or the capital of the organization, right? New York is still the capital, and the headquarters are still in New York. It's more about the fact that even as these big banks are building campuses, and even as Ken Griffin is investing in an enormous office in Miami, what does that mean? It means that they're bringing opportunity to lower cost of living or lower cost base centers, right? Yes, Ken Griffin is building a new enormous building at 350 Park Avenue over the next couple of years, and Jamie Dimon just did it in New York, right? But I think, what they've done is tax purposes and cost saving for the fund or the organization more broadly.
And how do these firms think about attracting talent to those respective locations? I mean, you mentioned Miami and Dubai.
Yeah. Yeah. I mean, that's a great question, right? Like, there has to be some element of a sell, somebody who's been firmly planted in the Northeast, right? Having to move to a Dallas, or somebody who's been firmly planted in London, moving to Dubai, New York to Miami. How do they sell it? One way, and this is fairly matter of fact, one way is that the only option is to move to that location. In other words, if you want this job is only located in Miami, right? The pod that we're building, or the team that we're building, is located only in Miami. So it depends, right? Because working at Citadel is most of the time somebody's dream job, right? So if they want their absolute dream job, it just comes down to how willing are they to move to Miami to do so, right? Or move to Dubai to do so. It's similarly, or maybe differently, some candidates view it as a pit stop, right? If you think a lot of the Western traders in Europe who are moving to Dubai, they don't plan on settling there forever, right? It's a few years. It's kind of like Cristiano Ronaldo, right? He just signed a massive deal. I can't remember if it's Saudi Arabia or UAE.
Yeah.
He just signed a massive deal to play football for like 2 years, right, in the Middle East. He's not gonna settle there for the rest of his life. But for a couple of years, you go play for a couple of years. You go trade for a couple of years. Don't pay taxes, and then come back. Those are other ways that candidates are kind of thinking about these types of approaches as well.
And on the topic of the way candidates should think about their approach, you've been in this space of recruiting and focused a lot on hedge funds, really seeing how their hiring processes operate. What are the cases where you've seen someone where they're able to stick around in the industry and really thrive versus, I guess, burning out or even not even landing a job? Like, what differentiates people in this space?
That's a good question. I think intangibly, my short answer is they're just wired differently. But there are a lot of candidates who work at banks and think that a move to a hedge fund is the ultimate goal for them, right? The way they might work at the way banks might be a feeder to private equity, they might also be a feeder to hedge funds for certain candidates. But sometimes the candidates are open to returning to a bank because of stability or, hours or things like that. So my short answer is they're wired differently. Again, that's a bit of a qualitative, intangible answer. They're wired differently, but how they stand out is these are people who are inherently, incessantly driven to break down barriers, right? I think that's what probably differentiates hedge fund talent from other industries, even other talent in financial services. They're never satisfied. These are people, literally, these are people and these are organizations whose existence is to be like milliseconds better than their competitor, or, the smallest percentage of arbitrage, whether it's time or alpha or what have you. They're always trying to fine tune and look for opportunities to make an extra dollar, right? Or advance a technical program or an internal proprietary application, right? To me, that's what I've found. And again, my expertise is primarily through my conversations with clients rather than it is candidates generally. So the reason I'm able to give you this answer is because that's what our clients look for, right? That's what our hedge fund clients look for. They want people who are driven by incessant desire to just continue like being this much better, because that's really what the hedge fund industry is about.
From your conversations with people, do you think you were able to tell when someone's going to be a winner in this space versus not?
That's a great question. I don't know if I'm the best person to answer that, to be honest, because I don't speak to candidates very often, if at all anymore. But I would say if I'm answering for my teams here, to be honest, I think sometimes, right, the more we work with clients, the more we work with candidates, the more we understand their teams. I would say sometimes we know, we can hang up the phone and say, that's the placement, right? That person is just made of it. Oftentimes, and other times, really, the client is the one who can sit there and say, they're our material. So we do our best, but ultimately that's why we partner with the business development and talent acquisition teams at our clients, is for them to really help make those final calls. But we understand their businesses really well, that we can provide them, that right talent in the first place.
We've spoken about what makes exceptional players in the risk-taking side of things, right? In let's say analyst or quant, or let's say even for tech talent. What makes an exceptional business development guy at a hedge fund? You've recruited, you work with the pod shops. Obviously you can't say specifics on which ones, but you work with big ones, let's just say, right? What makes someone an exceptional picker of PMs, of analysts, of quants? Would love to hear it.
Another really interesting question. And I should probably refer you to a friend of mine and former colleague from Selby, Jennings, who moved to Millennium to do this exact job, because he probably has the exact answer. You're talking to somebody who's stayed on the agency side for the last... So I can try and evaluate my clients from afar. Again, in short, I think the answer to that is the people who understand the client, like to the core, the best, right? So let's take any of the big, the 4 multi-strats that you just mentioned, right? We haven't mentioned Point72 yet. Let's give them some love. The best BD people at Point72 could speak could embody Steve Cohen's mentality and life to a T, right? Maybe not his lifestyle per se, but they know exactly what he is about. They know exactly what the groups that they represent are about, and they are freaking experts in their market, right? So the first things first is they have to be the best recruiter, right? One of the best recruiters in the world in their market. That to me is like the no-brainer, obvious answer, because they're in recruiting at the world's best. But other than that, these are people that represent their clients absolutely perfectly. And they represent their clients by knowing everything that they're about in a way that also represents the culture of the client, right? They're cutthroat when they need to be. They're intense. They have a work ethic that perfectly emulates the style of the organization that they're from, right? So those traits, to me, are what make them so great at their job. Not to mention, they are freaking incredible salespeople, right? To convince somebody to leave whatever, deal package or offer package they have at Meta or another one of the multistrats or some incredible startup offering zillions in shares, whatever, to convince these individuals to leave those opportunities to join their fund. They're also, world-class salespeople. Okay. So in summary, I think their ability to master their market, to represent culturally and in their heart the firm that they work at, and to be excellent salespeople. That's what makes really strong business development professionals in the hedge fund space.
Jesse, we know each other through our friend Doug and Doug Garber. And I did a podcast with him. I was on the phone with him, I think it was last week. And I was talking about roles, talked a bit about quant. But after doing the podcast now, I've gotten really interested in what the business development side looks like at these large multi-strats. I've gotten really interested because I love these conversations. I am very technical, but conversations I found by doing the podcast, I always enter a state of flow and I love doing it. And whenever I speak to a hedge fund manager, someone who's building out a new quant fund, they always talk about how it was so different from running money at one of the previous pods because they had to build up so many things from scratch. And the skill set required was completely different. Now, in my mind, I'm thinking that the ideal team of, let's say, a startup fund looks like an exceptional A-player BD guy and an exceptional portfolio guy. I guess just to throw a pretty wild question out there, but is there a path for the BD guys to own some risk or like in the form of, I guess, picking the PMs and owning a share of that or starting their own fund? I'm curious.
I will caveat my answer with I am not the eminent source of knowledge for this question. Okay. I will say I'll give you my own opinion, but I am certainly not the one who whatever I say goes for this. I'll tell you a story. We were meeting the head of PM recruiting, head of business development, as it would be called, at one of the 4 multi-strats that we've been talking about, right? This is a couple years ago. We were meeting with him and talked for an hour or so. And I left the conversation, and you could have told me that that was the person who runs whatever pod at that fund. You could have told me that that guy was the head of rates trading or the head of, statistical arbitrage at whatever. I was so impressed with how well, again, kind of to the point that I just made, right? I was so impressed at how well he knew his market and he knew every small detail around how the traders themselves think and how they operate, that I could have been convinced that that was the trader himself. Having said that, do I think that these people, do I think that the BD leaders could themselves own and run their own fund, or at least own and run their own book? It's actually the other way around. Oftentimes, former traders go into BD and go into recruiting because they have the network, they have the book of business, they understand it, obviously, intrinsically. So they become the agents to the industry. There's actually, again, another article from earlier this month or last month. There's an individual who is launching his own agency and he's going to make PM placements exclusively. That is a lot more likely than the inverse. Somebody who's a head of BD going to become a trader. Again, and I'll just to wrap this up, give you a short answer on as to why this is the case. At the end of the day, BD people, I wouldn't consider myself a hedge fund BD professional, but I work in recruitment and sales similarly to the way they do. We're people persons, right? So while we understand our markets and the pods that we represent to our core, we are not, generally speaking, we are not as analytical, quantitative, right? We don't necessarily have those skills that a trader absolutely must possess in order to succeed in their role, right? So I think the opposite can happen a lot more often, where the business development professional, where the portfolio manager can go into BD or recruiting, and we see this outside of hedge funds as well, right? There's an individual who runs a small recruitment company of about 30, 40 people, who used to be one of the most senior traders at Bank of America and decided to go into the recruiting side of things because of his network connections. So it's much more likely to go that way than it is the other, although they're always really impressive the way they know their businesses.
No, I agree with what you're saying. And I wasn't thinking about a BD person running a book. But next week I'm speaking to Tyler Erickson. I don't know if you're familiar with him, but I read an article on Business Insider. And he's starting a new platform called Riptide Advisors, and they want to raise I think the article cited $640 million. Tyler, being primarily a BD guy, was telling me that how insanely valuable that skill set was, and how by having an exceptional skill set in that domain, he's able to own a big piece of the pie. And so I guess I'd love to hear your thoughts on that as a sort of unconventional approach to building up a fund. And it's just a thought experiment, really.
Yeah. Well, what I think the key point that you just made there that I would like to point out is, I think you mentioned he has a finance background, or he's previously run money in some form, right? So that skill set exists for him. So now what he's doing is kind of pairing both, right? So do I think somebody who might have started their career in agency recruitment, excelled at it, went somewhere else, in-house, then became the best BD professional, out there in the market? Do I think that person could, kind of make those decisions that you're referring to now? I'm not really sure. I don't know if I'm the best person to, answer that.
So we've spoken a lot about the industry, about what the funds look for, and then now about BD and what the nature of it as a role and the potential for it. I guess I'd like to, just towards the end of the episode, but when you started your career in recruiting, were you speaking to, I guess, undergraduates and graduate students who were looking to be placed into funds?
So I started my career in risk management.
Okay.
So I was placing less so students. We don't really do graduation or graduate recruitment at Thaden International. Mostly experienced hire. So, minimum AVP, VP level at a bank, executive director at a bank, as far as the titles are concerned. That's where I have spent my career for about 3 years, was placing those types of professionals into financial services institutions, banks, startups, hedge funds, what have you.
And from all your experience of working with all these different sorts of people,
yeah,
what are the traits that make for not just extremely high performance at a top fund, but make for a satisfying career, a great career in general?
I think first and foremost, people need to be motivated and inspired by the work that they're doing, right? And I think the reason hedge funds are such a great place for the talent that qualifies to work there is because, as I mentioned earlier, right, they're so, in the best way possible, so insanely driven by small marginal gains and an absolute, top or best performance. That people and think like that, people who want to be involved in that type of opportunity thrive. They thrive at a hedge fund because they operate the same. And, from a client side of things, something that we find and we often consult on and try and offer as well, ways, if we think about it from a retention perspective, it's also about being able to create opportunities to find or to create inspiring work, right? Oftentimes we'll find, candidates start to hit the market, not always just out of spite because they didn't get their bonus or they got their bonus and now it's time to leave, but it's usually when time is up, right? Things have gotten stale in their role, or they've been at the same place for a while and they haven't really seen the growth that they're looking for. So, what I find in candidates and what they're for the most part motivated by is, opportunities to do challenging. This is why people want to work in financial services, right? Ethan, we literally speak to astrophysicists, right? PhDs from Stanford in molecular biology, astrophysics, and other 8 and 10 syllable words that I can't pronounce. Okay. But they want to work in financial services. Why? Because the problems are equally challenging. And if you look up there at the stock ticker, you can see that it's moving because of decisions that they've just made. Right? So being involved in the global financial system is far from insignificant. Okay? So these people want to be challenged. They want to be stimulated. And that's what we find in the best of the best candidates. We work with a lot of global leaders in financial services, banks, hedge funds, and otherwise, insurance. And that's generally what we find in like the real, the best of the best clients, because they provide the best of the best opportunities for the best of the best candidates to really challenge themselves and solve interesting, intricate, complex problems. Relevant, interesting, intricate, complex problems.
Absolutely. And I think that finance often gets vilified as all these people are just extremely greedy and just want money. And obviously money is a nice incentive, but you can't stick around if that's the only thing going for you.
Not at all. Not at all. I say this shamelessly. It's the West. Capitalism exists. It's not going anywhere. And there's no problem with that. Just because you're a capitalist doesn't mean you're greedy. It means that you want to work hard and you want to earn money for working hard. And to me, that's what capitalism is. That's why I live in New York City. I'm a capitalist, but I don't think I'm greedy. I want to work really freaking hard, and I want to live a life that I enjoy. And that's, people who work in financial services, I agree with you. They're just really interested in solving really interesting problems.
I love that. And I think that's a great place to wrap things up. Thanks a lot, Jesse. I think this conversation was very, very insightful.
Thank you so much, Ethan, for having me. I've really enjoyed this, and I hope your audience has been able to glean a takeaway or two, and I hope they found it interesting.
Thank you.
That's all for today's episode of Searching Smarter. If you found this conversation valuable, be sure to subscribe so you don't miss an episode. Until next time, keep searching smarter.